Welcome back to the channel, everyone. Today I want to talk about how the tide is changing for the short sellers and how those short sellers appear to be giving up. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, the real Darkpool tweeted saying, why would short selling firms go long only in a bear market? Now this comes after the recent hedge fund, SB Northstar, liquidating their $1 billion portfolio after reporting a $16 billion loss. I assume they had a $17 billion portfolio and they've lost $16 billion of that portfolio and therefore only have $1 billion remaining, which they've cashed out and left with. The executive left the firm in order to focus on his long-only hedge fund. Now again, you may have heard the words long only recently before. If you didn't already know, the hedge fund that lost nearly $7 billion betting against stocks like GameStop is raising cash for a new long only hedge fund. So it seems like Gabe Plotkin and Melvin Capital aren't the only fund that are switching to a long-only alternative in a bear market. So SB Northstar was an internal hedge fund at SoftBank, and SoftBank has liquidated almost all of the positions in the internal hedge fund, SB Northstar, following losses of between $6 and $7 billion from the so-called NASDAQ whale traders. And it even says, citing regulatory findings, the Financial Times reported on Saturday that SB Management, Northstar's investment manager, held a bit more than $1 billion in US listed stocks at the end of 2021, down from more than $17 billion a year earlier. So it seems like tons of these hedge funds are liquidating their short positions to go long only. But as Darkpool asks, why would those short selling firms go long only in a bear market? He said a bear market is a short's playground. They don't think short term, even though they go after volatility and stocks that are detached from fundamental values. And he said it's because they know that transparency is coming and they can wave goodbye to that grey area. Previously, things like naked short selling, even though they were illegal, the SEC, the FBI, the DOJ and everybody else basically did nothing about it. But Darkpool believes that now transparency is coming due to all the changes in regulation and the massive increase in retail investor interest. And he said mid-caps are going to blow out the short sellers once the cost to borrow starts to rise system-wide. Right now, we're obviously seeing that cost to borrow rise in GameStop, but many other stocks across the market still have a cost to borrow of between 0.5 and 1% per year. But obviously, as the cost to borrow starts to rise in all of these smaller companies, it makes borrowing shares harder and more difficult, and it means that shorts will struggle more and more. Shorts won't just be struggling on GameStop and AMC, they'll be struggling on every single one of their short positions. And he said this dovish approach to lending has sent the economy into a tailspin. Lending is good for growth, but not when it's focused into speculative plays such as NFTs where people made millions. He said we're in an economic bubble supercycle where banks have offered more loans than they were able to systematically handle. In 2008, banks were leveraged by a ratio of 12 to 1 maximum. This time round, they are levered 100 to 1 and above. Citadel, for example, is levered 8 to 1, but some banks like Goldman Sachs in their derivative positions are leveraged over 113 to 1. And he said the Fed can take a hawkish approach, but it's not easy to increase interest on $30 trillion worth of debt without causing an economic crisis. The market can continue like this for a while before the big crash, but it's only a matter of time. Now you may know John Hempton, a short seller from his recent interaction with Corey and this user here on Twitter. The user tweeted saying, "We are not nervous, we are cool, calm and collected." John replied saying, "Yes, you're not at all hysterical about naked short selling and stock manipulation." The user replied saying, "Maybe some are, but my shares just hit long-term gains. What's your opinion on the no halt on the move up to $34 yesterday, but a halt down on the downtick?" John replied saying markets have volatility rules because these halts are actually based on a moving average price, not necessarily the opening or closing price. But John also said, really, if you pay enough to brokerages, you can get them to call the volatility halts for you. And he said it's good to be the king. Now obviously Corey replied to this tweet saying, does money buy horse? And also he picked up on the fact that John said it's good to be the king. Corey's wondering if John is the king in this instance, or maybe it's somebody else, like Citadel and Ken Griffin for example. Obviously when people have enough money, like Ken Griffin, they can basically buy whatever they want, and they can basically buy their way out of SEC investigations, and basically buy their way into volatility hawks that benefit them. But a little while later, the average ape tweeted about John Hempton giving up on his AMC and GameStop short position, and said that short hedge funds are giving up, and they are admitting that they can't win. Guys, if you didn't already know, MooMoo and Futu have just officially announced that Futu does not accept payment for order flow, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. And right now you can currently get 5 free stocks worth up to $3,500 each when you sign up to MooMoo using the link in the description below and make your first deposit. MooMoo also recently won the award for being the best trading platform in the FinTech Breakthrough Awards. MooMoo is also entirely commission free, has tons of technical indicators and advanced charting tools. MooMoo publishes daily short selling data, position cost distribution and much more. MooMoo is also incredibly easy to use, very customizable and will help you to trade like a pro. So guys, be sure to sign up to MooMoo using the link in the description below to get up to a total of $17,500 in free stocks. John tweeted saying, as for AMC and GameStop for me, he's signing off. And also said, I don't know which cards Ryan Cohen is playing, he has a better hand and he is not likely a bankruptcy risk. He said that Ryan Cohen is also a better player, but it is a tough hand. So it seems like many shorts are starting to give up the profession of short selling even though we're in a bear market because they've taken on such significant losses over the last few years. I think we'll start to see more and more short-only hedge funds giving up over the next few months and turning into long-only hedge funds soon after. I do also think that AMC and GameStop will basically be their last stand plays and the last short positions that they actually give up on. In many of their short positions on other stocks, not including AMC and GameStop, they haven't created synthetic shares and naked shorts, and therefore they can close their legit short positions and not take on too significant of a loss. Many of these hedge funds may be able to escape with only a few $1 billion in losses because they didn't naked short many of these companies. But obviously on companies like AMC and GameStop where they did naked short and they did create billions and billions of naked shares or synthetic shares, they obviously can't close these positions without going entirely bankrupt. And therefore, many of these short sellers that don't have naked positions right now will likely be closing down shop over the next few months and turning into long-only hedge funds. But obviously any of these short sellers that do have naked shorts on AMC and GameStop are likely to give up on their other short positions first, trying to make a last stand on AMC and GameStop so they can at least avoid entire bankruptcy. But obviously I do believe we are in the end game and it's only a matter of time before these short hedge funds that are trying to give up on their other short positions have to give up on their AMC and GameStop shorts as well and just admit defeat and admit bankruptcy. I found this brilliant quote, and I never knew that this quote actually came directly from Warren Buffett. But he said, only when the tide goes out do you discover who's been swimming naked. This is a quote in reference to the overall stock market and more specifically to naked shorts. He says, only when the tide goes out, aka when the market crashes, do you discover who's been swimming naked, aka massively over leveraged and holding massive amounts of naked short positions. Obviously, when the market crashes, any of those hedge funds that have those massively irresponsibly over-leveraged long positions end up being liquidated, which obviously causes short squeezes in some of the more heavily shorted stocks, exposing those companies that hold massive naked short positions. So therefore, Warren Buffett is saying that when the market crashes, we will discover which hedge funds are holding those naked short positions that are massively over-leveraged. And Unusual Whales tweeted saying Harvey Pitt, the former SEC chair, has said that the rules do not go far enough. He said there should be 0 instances of naked short selling. Therefore, even the former SEC chair is admitting that naked short selling does still exist on massive levels. This is a vast difference to this time last year when basically everybody at the SEC or everybody that worked for any hedge fund completely denied the existence of naked shorts. They were saying that naked shorts did not exist and that you are crazy if you believe the existence of naked shorts. But now even the former SEC chairman, Harvey Pitt, is saying that naked shorts do exist and there should be 0 instances of naked short selling, but the rules do not go far enough. But interestingly enough, this user says, FYI, I received my stock and options trading license back in 2005, and this was the exact same thing being said back then 17 years ago. Now obviously we know that basically nothing has changed over the last 17 years, but he said let's hope there's some actual reform given the amount of retail participation this time around. Now I believe this is what Darkpool was hinting about earlier. These hedge funds know that transparency is coming because the stock market is now just far too exposed to that retail presence. When the stock market was full of solely institutional traders, they basically did not care about the corruption because they knew how to make the corruption work for them. But obviously now, retail investors are investing in the market in massively large numbers, and obviously corruption does not work for us, and we are demanding change. These short sellers know that change is coming, they know that transparency is coming, and they know that no longer can they get away with these grey areas such as naked shorting. Now interestingly enough, somebody that does seem to be fighting back against the corruption is the UK's Financial Conduct Authority. Angelo tweeted saying the FCA, or Financial Conduct Authority, and the Bank of England will undertake a review into the governance, market oversight and risk management of the London Metals Exchange after a massive short squeeze led to weeks of turmoil that paralysed the nickel market. Now again, this may just be more false promises or lip service by the FCA and the Bank of England saying they'll perform an investigation but not actually doing anything credible. I for one hope the FCA and the Bank of England actually perform a proper investigation and that ends up with some criminal sanctions or criminal sentences. Something else I think is very, very interesting that could suggest that Ryan Cohen, Adam Aaron and Patrick Byron are all working together is this tweet here from the real Darkpool. There's an extract here that says Byron, who did not respond to an email requesting further comment, was prepared for his detractors. He said he saw the digital dividend as a litmus test for the SEC to determine whether they're in the business of protecting American retail investors or if they're still in the business of protecting Wall Street cronies. Byron said the digital dividend was a well-planned instrument and it had been carefully vetted by a high-powered white-collar crime lawyer who's also worked with the Drug Enforcement Agency. Maybe Adam Aaron and Ryan Cohen have been creating all of these little litmus tests for the SEC to determine what side the SEC is truly on. Obviously, Adam Aaron's investment into Highcroft Mining would have unveiled if there was new synthetic short positions taken out against Highcroft. And I think Ryan Cohen's GameStop dividend and stock split could be another litmus test for the SEC to determine what side they're really on. Guys, be sure to let me know down in the comments below what you think about the tide changing for the short sellers and those short sellers giving up. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.